I wait? Because I think rates could go lower. Scott, I think rates could go lower. I'm out here with my home in Colorado, and I'm like, man, why refi right now when if I wait a year, I could refi then? Why wait?
So I think that no one has the crystal ball, obviously.
I
It's one
do.
of those situations. You
I
do.
do.
I
I
know.
have a crystal ball.
Mine's not working.
Mine
But
doesn't work either. I have one, though.
gotcha.
Just want to be clear.
No, and this is a conversation I have with my clients all the time because I have several people in this position, one of which whose loan amount is over $1 million. He's going to save a little over $1,000 a month off of his current payment because his rate's in like the high 7% range. So it's one of those things where if you look at the rule of thumb is you want to drop that interest rate at least 1%. Now, granted, if you're dropping it 0.5% to 0.75%, it may still make sense if you plan to stay in that property in the long run. So that's really the question, is how long you plan to stay in that home, because you're going to have a recoup period after closing where you've got closing cost, you've got, government recording fees, in some cases transfer taxes, the recreation of your escrow account, title cost. So on average, you're probably looking at 1.5% to 2% of your loan amount in closing costs, depending upon the state. Sometimes a little bit less, like some states don't have transfers and stuff.
Okay,
So
you're getting ahead of me because I was going to ask about closing costs, but
sorry.
And let me simplify my question.
Yeah.
What's like that percent that maybe I should look at refi? Because it's easy to look ahead and be like, wait, maybe they will get lower. But at what point, like let's say if I had a 7.2, if I can get a 6.2 now, should I be looking into it? Or is, like you're saying, do closing costs and things like that factor in as well?
Yeah, if you can get a 6.2 and drop that rate 1%, I would do it if you plan to stay in that property. If you're
Why is
planning to
that?
sell it in 6 to 18 months, it may not make sense because you're not going to recoup the closing costs associated with refinancing through that monthly savings. So that's the question, is how long they're going to be in that property. Let's just say they're incurring $8,000 in closing cost, but they're only saving $300 a month. It's going to take them 2.5, 3 years to recoup the cost of that refinance through the monthly savings. So if they plan to sell before that time frame and they're going to sell in 9 months, it wouldn't make much sense because you're incurring more cost than you are saving.
So what I'm hearing there is, if I am refining, just to be clear, if I am refining, I have to look at the actual cost of doing the refi?
Correct. Yeah, and there's also programs where you don't have closing costs, like the FHA Streamline program, USDA Streamline program, where we credit all the closing costs. There's no appraisal. So it also depends on the program that you're going with, because if there's no cost associated with it, you're not setting yourself back. It's a little bit different.
And the Streamline program does have that. Okay. And
Yep.
as we sit in October, I almost said September. Happy October, friend. Happy spooky season.
Crazy, man. I know.
As we sit in October, should people be waiting for lower rates?
I wouldn't count on it.
Why
I
is
think
that?
that
Because there's a lot of people that are counting on fingers and toes counting on it. So why should they not be counting on that?
I know. Well, just 3 weeks ago, they were saying that we may see 3 to 4 cuts before the end of this year. And then just a couple days back, they have revised those expectations to maybe 1 or 2 cuts. And there's only a 65% chance of that. The problem is this is all speculation, and the Fed says a lot of stuff. Jerome Powell says a lot of stuff, which impacts the markets and moves the markets. And the economic data, the employment data, inflation, that is all going to dictate what happens moving forward. And until we have that information, it's a guessing game, really.
The guessing game side of it, that's the frustrating part. That's the frustrating part, even for me. And Zach just commented, really enjoying this, listening while I'm at work. Zach, love your name, dude. Love the name. Comment if you're enjoying / have a question around any of this. We also got the text line. Got the text line in front of me. If you have anything that you want to bring up conversationally within the show, you can call or text the line. I think both are open. Let me double check before I shout that. Yes, both lines are indeed open. Now, when it comes down to actually obtaining a refi, that's easy, go to you. It's a matter of when for, I think, a lot of people. I have a mortgage. I have to look down the barrel of paying refinance costs, and now I'm having to do all this math. So you're telling me the rule of thumb, though, is if I'm not planning to sell in a year and I can drop 1%, do it?
Yeah, I would say yes. I mean, it depends on exactly what the numbers shake out to be and exactly how much cost you're incurring. But if you're going to sell that home in 18 months and you're incurring a ton of closing costs, it may not make sense. So that's where you have to do that calculation of what your costs are associated with actually refinancing and those closing costs, and what your monthly savings is, and how many months of that savings it's going to take to recoup that cost. That's really what it comes down to.
It's a lot of math.
It's not too bad. I can calculate it for you guys. Come to me and I'll do it for you.
Ah, little plug. I love it. Let's go into something that I think a lot of people are going to be curious about. Are we getting back to a world at any point? Should I be crossing my toes, waiting in line for the day where I can walk into a home, Scott, and I can look at windows that aren't foggy. I can look at the floor nice and freshly cleaned. And I can see 3, maybe even 4 bedrooms that aren't falling apart in a home where I could have a mortgage payment of like $1,300, $1,400. Is that coming back?
I don't think so.
Dang it, man.
As much as I wanted to, I do not think it is.
Double tap the live if you hate that. Also, I have a notification setting put on. If you guys double tap the live 250 times in a row, your name pops up on the screen. I think.
Dang.
Test me.
That's a challenge right
Test
there. Come
me.
on.
I think it works. I think your name. Ah, Zach.
There it is.
There it is.
Zach.
Told you it worked. Now, KC wants his name pop up on the screen. I love it. The engagement tools are working, Scott.
Let's go.
We're testing out new things here. I love it. Well, we've always talked about don't gift us. We don't need your money. TikTok gets most of it anyway. Double tap the
Save
screen.
it for a down payment.
Newark. Yeah. So let's talk Newark. Delaware or Newark, New Jersey? Delaware. He answered before I even asked. Newark, Delaware. Scott, if I were to go refinance government today, what's the lowest we're going?
Probably the mid 5s. It really depends on the credit score.
And when we say credit score, what are we hoping to be around?
If you can be over 640 to 660, that's pretty solid for the most part. If you're over that level, the rate's somewhat the same across the board with FHA. It's just not as credit driven. If you're in the 580 to 620 sub range, there's adjustments for that. So it might be in the higher 5s, depending upon that.
Higher 5s. Okay.
Dang,
And
Zach.
Zach
512.
And Zach says that gifts. See, that's where I'm caught, Zach, is people do give gifts when asked. And also it does push the live. I don't want people spending their money on this at all. I would much rather just double tap in the live, sharing it, all that. If it pushes, it pushes. It doesn't, it doesn't. We've had lives together with hundreds of people in here, and we've had it with 8 people in here. It's everything in between is doesn't matter. And especially if you're tuning in on YouTube Live, hi. If you're watching this 3 months from now on YouTube, hi. I would be very curious to see what the rates are going to be, because that actually goes to my next question. Do we think rates continue to go down until the end of the year, or have we kind of seen the bottom out of the mortgage market, at least for 2024?
I think it's a toss-up. We could see rates go slightly lower, maybe 0.25% to 0.375%. And we could also remain stagnant or slightly elevate depending upon the data, to come. Like if inflation ticks back up and the job market remains stronger, we may see them pull back on potential cuts, which might have rates trickle up slightly. So I don't foresee it dropping significantly before the end of the year, but if it does drop, I think it's going to be minimal.
Talk stupid to me, all right? Talk like you're giving a Barney lesson on this. I'm the big purple dinosaur, and I've instructed you to join me. I want you to explain to me what you just said in Barney terms. How does this rate go down? Because frankly, I watched it skyrocket up. Maybe as soon as I was getting into the market, maybe as soon as after I bought my home, blah, 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 blah. It doesn't matter. I've seen it go up. I know it can go up. How could it go down? You just mentioned things like unemployment. You just mentioned things like inflation. Talk Barney to me, man.
Yeah, so over the last 2.5, 3 years, the Fed has been hiking the federal funds rate to help tame inflation, because hyperinflation was absolutely insane. The government was printing so much money and everything went up drastically. We've all seen it. We've all been impacted by it. So the Fed started increasing the federal funds rate, 2.5 years ago, to help combat inflation. And it got all the way up to 7% on the mortgage rates, which obviously stunted the housing market a ton. It cooled inflation off a ton. And now inflation's back down to the 2% level that the Fed was shooting for. as a result of them hiking rates. And because of that, over the last 90 days, the job market started to look like it was deteriorating, meaning the unemployment rate was going up, which was showing, signs that the economy wasn't as strong
Yeah.
as some people may have thought. And over the last 30 days, that has kind of tipped the scale back towards the other way, where the job market's looking a little bit stronger. Inflation is still down,
Okay.
but
So if
you know,
inflation stays down and the job market stays relatively decent, you're telling me if it doesn't get too strong or too weak. Because if it gets too weak, then we're talking about recession type stuff. Where
yeah,
the unemployment
which
rate's
then
going
rates
up.
have to come down further. So
Okay.
that's
So
what it's all going to
that's
depend
what the
on.
balancing act kind of is. That's why we don't just see them just dropping the rate, because they don't want to see inflation, but then we don't see the opposite
Exactly.
happen because they don't want to cause a recession.
One, it's just like how they hiked rates. We
Yeah.
saw that it was an incremental hike over the
Historic. I
course
see
of
your comment, by the way. 1 second.
18 to 20 months. They hiked the rates because they had to watch how the market was reacting and see what the response was before that they made that next move. It's going to be the same with the rate cuts. It's going to be testing and seeing how things react and taking it from there.
That's the part. I love that you said that, dude. That's the part that every lender needs to understand, is that every move that we're seeing today is based off economic data that we've been analyzing from the past 45 days and before. Nothing that can be predicted in front of us can be predicted farther than 30 to 45 days. Maybe. There's a lot of people, not you, in your industry that yell about rates are going to get lower. Rates are going to do this. Rates are going to do that. And frankly, if you're looking past 2-3 months, you're out of left field trying to predict that. You can hear us even just like, hey, what do you think end of the next 3 months is going to look like? Where there's people already, dude, I hear it talking about next summer rates are going to be X. Dog, you have no clue what's going on, man.
It's so true.
It's wild to me. Bex just texted into the line. Lines above. If you got a text in question, please hit up the line 302-265. You see it right there in the corner, 0021. Bex just asked, longtime listener, right now aggressively house hunting, but we keep losing out on houses. Sorry, Bex. Ultimately, we're probably getting beat out on all cash offers, but how can we be more competitive? We have zero debt, over 750 credit scores, and 20% down. Our realtor is suggesting we start waiving inspections, but that scares me. What else could we possibly do to win a contract on a home feeling miserable here in Northern Virginia?
I don't know if you want to go first, but I'll go. If you
Over
want.
to you, Scott.
Yeah. I mean, one thing I can think of, especially with you putting 20% down, and this is a situation that I just had with one of my clients that just went under contract. With that size of a down payment, you can likely get an appraisal waiver with conventional financing where you don't need to get an appraisal. If you can waive that appraisal as a part of the contract, that will strengthen your offer so much. There's no contingency associated with the potential value or repairs that could pop up. They could throw a monkey wrench into the transaction. And that definitely helps. But outside of that, I mean, obviously waiving inspections helps, but that puts you at a bit of a risk.
Yeah, don't tell people to do that. Don't tell people to do that. They're going to clip you. They're going to clip you.
I would not do that, but
I would personally never advise it. Yeah.
Same. Yeah, I wouldn't. I've seen so many people do it that, in 2020, 2021, they were so desperate to get in the house because it was so competitive. And now they're in a position where it had $48,000 in termite damage or something that is a serious problem that they're now facing because they didn't do their due diligence. And
of course, that's the con to the pro of it. Where I sit on this issue is if we're getting beat out by all cash offers, I wouldn't look at that as the number one factor as to why you're losing. The reason I say that is because cash isn't king. People be talking about cash is king. Can I tell you, cash is stupid? Cash is dumb. If you're walking in and saying, I got $800K to put on this house, I immediately think one of two things. Either A, you're a multimillionaire, or B, you're stupid. Because you're not, in any good financial sense, going to lock up all of your capital into equity on a property unless A, that's like less than 5 to 10% of your total holdings, which if that's the case, amazing. Or you're just going to lock up a significant amount of your capital that's going to sit and lie and maybe grow, possibly, in equity. So anybody who has money, Scott, you've seen this, people who are astute, that have economic sense, that have financial sense or literacy, I should say, that are of high net worth, usually still take on 10, 15, 20% down mortgages, no?
Yeah, yeah, they absolutely do. I mean, it's I have somebody right now that just went under contract who has several $1 million in assets and is putting a good chunk of change down, but she's still financing 250 grand because she doesn't want you to take all of that money out of her assets and put it, into this property when she can yield a higher return elsewhere, in terms of the rate that she's paying on the mortgage compared to her return elsewhere.
Want to
Just
give a
makes
quick
more
shout
sense.
out to KC, Ganesha TV. What's going on? Historic Grounds recently said, sorry, missing your comment. We do have the text in line. We're going through these refi comments. If you're coming into us on YouTube, what's going on? We are live on YouTube and TikTok. So if you want to text the lines, 302-265-0021. And one of the questions that came in earlier was, if I have an 800 FICO score, what's the cheapest program I could go through to get the lowest mortgage rate?
I would say conventional financing if you have an 800 credit score, just because
Mm,
the PMI is going to be based off that credit score. So if you're in that higher credit score tier, conventional financing will likely make more sense. Your payment will probably be a little bit less upfront, but in the long run, the PMI will go away when your loan amount reaches 80% of the property's value. Whereas with FHA, if you're only putting 3.5% down, they make you pay that for the life of the loan.
got
So,
it. That makes sense. Shout
yep,
out Casey, Joe. Quick shout out if you're in the chat. I see Chasey, Joe, Anastasia, Historic Bex, all on the like leaderboard. Zach Finch is running the like leaderboard, though.
he is crushing it.
He's killing it.
2,500.
Dana's up there at the top. Love it. Big Little Love. What's going on? Text in the line if you got a question around interest rates. Otherwise, I want to get into my personal, out of the questions I have written down, I got to be honest. 7 of them are for others. 2 of them are for me. All right. This is one of them that's for me. All right. Ready?
Yeah, I'm ready.
Should I refi and take my equity out to pay down other debts, or should I refi purely for the lower rate? To explain that, for those that heard that and just heard a bunch of math jumbo, when I do a refinance, I can do one of 2 things. I can either just take the lower rate. I can just take that lower rate. I can just say, okay, I want to own the same amount of home that I owned before, but I want this lower rate. You got to pay closing costs and everything like that. Or do I take on that lower rate and a higher loan balance? The trade-off with that is I get the money to then do with as I please. In this case, pay off debt. So bringing it back, should I look at refining, taking out the money to then look at debt? Do you do that often? Are you seeing that as a strategy? Talk to me as someone who maybe has a home and is thinking of refining and not knowing, should I just go after the lower payment or should I also take money out too?
Yeah, I mean, with how high rates have been over the last few years on car loans, credit cards, and just how expensive that has become, there is many instances where it makes more sense to take the 30 to 50 grand out from the equity that you have to eliminate 1,200 to $2,000 a month in minimum payments that, granted, you may have paid off in 3 to 5 years, but you can really improve your overall financial standing. And if you can finance it at a lower rate, I've even had situations where I had a client that came to me 2.5 months ago that had about 50 grand in debt. Who was in the same position, paying, I think, almost 1,800 a month on that debt
Mm,
because their rates were insanely high. They were able to take 50 grand out. They were at an 8.25% rate when they bought this home. I want to say it was like last August. They got a really high rate, and we were able to reduce the rate. Their payment only went up like $118 a month, but they were able to eliminate almost $2,000 a month in minimum payments on their credit.
mm.
So, and to add to that, the mortgage interest that you pay is tax deductible. All the interest that you pay on your credit cards, your car loans, that's not tax deductible. So,
Got it.
just
Okay.
an added
Well,
benefit.
and do you see a lot of people wrapped up in that scenario where they have all this equity, but they've also accumulated all this debt?
Yeah, there's a lot of people in that position. And if you just look at the data and just the overall debt of the American public, it's
We
at an
appreciate you,
all-time
Bex.
high. It's insane.
No, keep going. My bad. I was just shouting out Bex.
Oh, it's all good. No, I was just going to say, if you look at, the nationwide average in terms of credit card debt and where the U.S. public is. I think we're at the highest level we have ever been. As a result of hyperinflation and affordability and what has happened over the last 4 to 5 years, there's so many people that have charged up debt.
That's one of the items I feel no one talks about as much. We talk about affordability, right? We talk about affordability being a problem. Why are we not talking about the growing, gigantic number of household debt people are holding on to? We're above $1 trillion. I heard this stat. All over the place. Let me recenter. We're over $1 trillion. Passed this a December and a half ago for credit card debt. It took us 50 plus years to get to that number. We're going to get to 2 billion in 2 years. Or 2 trillion, I'm sorry, in 2 years. We're going to double it in 2 years. What took us 50 to get to approximately. People are putting utilities on credit cards. People are putting groceries on credit cards. People are opening up more just to do what they can to survive for now. That seems to me like a bubble that could pop at some point when the shit finally, pardon my French, hits the fan. And all of a sudden, we realize the truth of the matter that's been silent is that every household's accumulating more and more debt every single month. So you're telling me that if it comes down to it, you could refi and maybe take some of that personal burden off of yourself by taking some of the equity you have. But the big con of that would be a higher payment, right?
Potentially, depending upon how much you take. But it also comes down to your equity position. There's a lot of people that bought at the higher rates a year and a half, 2 years ago that don't have a ton of equity to pull from. And there's limitations as far as how much you can go up to in loan amount, and get cash back. So it depends on your situation and where you're at.
Would you recommend a cash out refi or a home equity line of credit to pay off that debt?
If they already have a first mortgage that's super low and they bought 5 to 10 years ago and they're in that 3% bucket,
Or even
that.
4 years ago, 3 years ago.
Even 4%, I wouldn't touch that at all. I would get a HELOC, finance that smaller amount, at the higher rate. That way you're not paying the higher interest on everything.
Yeah.
That would make the most sense.
So just to clarify, double tap the screen if that makes sense. You have a low rate, you go ahead and do a HELOC. You have a high rate, you go ahead and refi. Simple. Yep. Cool. Should anyone be thinking about ARMs, adjustable rate mortgages?
There's a lot of people that got into ARMs over the last year and a half to 2 years because of how high rates were. And there were so many people screaming that rates are going to come down, rates are going to get better. Just hang in there. You'll be able to refinance it. I think if you're in an ARM and you're in the 6% range, I would consider getting out of that ARM. I am not a fan of adjustable rates. I've never closed an adjustable rate mortgage in my life. I've just never been with an entity that really offered it or was competitive on it. But honestly, the risk associated with it, if the rates do go back up, I just don't think it's worth the risk at all. So I would look into refinancing out of it as soon as you can, if possible.
Why?
Just because it can adjust upwards. It could go up 2-3%. Obviously, there's caps associated with that, but there's no crystal ball.
It can only go to a certain height.
Yeah, it can only go to a certain level. So there's lifetime caps normally on an ARM where it can only go up to a certain rate.
Did those exist in the early 2000s, or is that a newer thing?
I think that's a newer thing. I don't think that was in the early 2000s.
Okay, gotcha. Just to draw the line between how it's different now versus then, there is at least a cap, but that cap is very much real.
Yeah.
Is the 3-2-1 buy down program, is that considered an ARM?
No, it's not an ARM. So in that situation, the first
can you explain
year of the term,
can you explain that to me? The 3-2-1 buy down program.
So,
is that still something you guys offer?
Yeah, we have the 3-2-1 and the 2-1 buy down. So, and what's really cool about it, which I didn't know about it up front, so the way that it works is with a 3-2-1 buy down, the first 12 months of your loan term on a 30-year loan term, that rate is reduced by 3%. So let's just say the going rate today for conventional financing, 6.25%. You would start out at a 3.25% for the first year. The second year, it would go to a 4.25. And then the third year, it would go to 5.25. And then at the start of your 37th payment, it would go back to the market rate that you closed at. However, the cost associated with that program, the 3-2-1 and the 2-1 buy down program, there's costs to buy that down that are paid up front, either by the seller at closing. Sometimes it can be paid by the lender. But what's really cool about it is if you plan, let's just say the rates come down, you do the 3-2-1 buy down and rates come down in 6 months to 4%. And you're like, man, I got to refi because I can lock in this 4% rate. Granted, I'm going to go up slightly, but it would have been higher than that next year anyway. So I might as well just lock this in. The good part about that is you'll be able to get a prorated credit back to your principal balance based on the amount of months that are still left over in that 3-2-1 buy down program.
You just lost me. Say that again. Yeah, my brain derailed right at that exact moment. So you said what one more time?
So the cost associated with those programs, the 3-2-1 and the 2-1 buy down program, that cost is paid up front at settlement, right?
Oh, so basically
buys the rate down.
Got it. I'm buying the rate down essentially to associate with that program.
Exactly. And what happens if you refinance before the end of that 3-year period and the rate reduction period, you would get a credit back towards your principal balance of the remaining buy down left over and the proration left over, because it's based on those 3 years.
Oh, you get your money back. Okay.
Exactly.
Nice.
So it doesn't go to waste, which is cool.
Well, it's nice that it's not a waste, but you're telling me that's not an ARM. And if you are in an adjustable rate mortgage, you should be looking to get out of it just for the mental health at night of knowing that rate's not going to change?
I would. Yeah.
Heard.
I mean, I'm not a fan of adjustable rates. I think it comes down to preference and risk tolerance too, but I'm not a fan of adjustable rates at all.
With inflation cooling down below 3% and the Fed, we're already talking about another big cut. We already mentioned that. Is refinancing a smart move or is it really a gamble to see, should I wait, essentially?
I think if you can drop your rate over 1% and you're planning to stay in that property in the long term, I would pull the trigger if you can. Just because there's, like you and I have been talking about, there's no crystal ball and there's no guarantee that the rates are going to come down even further. Granted, it's pointing that way, but it was also pointing that way in January of last year. And then the rates went back up to 7% for the last 9 months, 10 months. And then they've trickled down over the last 60 to 75 days, which has been great. But if inflation ticks back up, if the job market starts to strengthen, maybe a little bit of both, this could certainly go the other way quickly, like it did earlier this year.
Interesting. So again, talking about that correlation, you're saying interest rates go up if job market improves.
Correct. Yeah, if the job market strengthens, I mean, I wouldn't say there's a direct correlation, but it certainly points
Helen
to
Keller in the chat.
the
Sorry, Helen
economy
Keller's in the
looking
chat.
oh, you're fine. No, it just points to the economy looking a little stronger and, lower rates not being as much needed as they originally thought.
Comment just came in. Do you have any insight on after the 50 basis points are cut? We didn't see any drops in long-term rates. Why is that? Why is it when, in reference here, we saw the 50 basis points cut 2 weeks ago now, was it? Mid-September?
Yeah, 2 weeks ago.
Wasn't a lot of movement that happened directly afterwards. In fact, I think it dipped very slightly, 0.2, and then kind of right back up to where it was sitting at originally. We see that in the graph actually kind of sitting between us. Why is that? Why didn't we see the rates go down?
So it was a mix of a couple different things, in the days leading up to that Fed rate cut. If you look at that Monday, and I think it was like Wednesday or Thursday that they made the cut, the rates actually improved 0.25% at the beginning of the week because they were baking in the fact that it was likely going to be a 50 basis point cut.
What does baking in mean?
It means that they're just forecasting and accounting for the drop that is on the horizon in advance of it happening. And that's how it works with the mortgage industry, and it's all based on the speculation and what the Fed is saying and what Jerome Powell is saying.
Dumbass.
And those words create a lot of movement. So
not a big fan of Jerome Powell's. Not a big fan. All right. So what I'm getting from that is the Fed affects it, but a lot of it's speculation. A lot of it's investor money movement. A lot of it's not the Fed rate, and really what investors do because of what they see the Fed rate doing?
Correct, as well as Wall Street. I mean, there's so many different factors involved in it. To be honest, when I was originally looking at the rate cut, I was anticipating the rates coming down a little bit more when the rate cut went in place. Because if you look at what the original sentiment was, it was almost a toss up. You know, everyone originally was thinking it was only going to be a 1/4% cut, and then on Monday of the week when they were going to make the cut, it shifted to almost a toss up more towards 50%. I'm sorry,
Mm-hmm.
50%,
Yeah,
50
50 basis
basis point
points.
cut.
Yeah.
And that happened over the course of a couple days. And originally, I was thinking we were going to see a little bit more of an improvement because I want to say it was like a 60 or 67% chance, of a 50 basis
Basis
point
points
cut
over a
compared to the
25.
25 basis point cut. And I was expecting us to have a little bit more of an improvement just because it wasn't as guaranteed, but that didn't happen.
You, like many, like I, expected a little bit more movement, but you're saying a lot of it was baked in. How then, moving forward, if we're looking at November as the next target potentially for a cut, how do you manage timing that right? Should I understand that maybe once that, because I'm putting myself in the position of if I were trying to just nab the lowest possible rate, because of course you lock it in and it's yours for life.
Right.
Timing it sounds more or less like I have to think like the big investor, because we're looking at unemployment rate, we're looking at inflation, we're looking at CPI reports. But to break it down simply, it seems like when the Fed gets closer to 100% chance of X happening, investors move based off that. And maybe that's the opportunity to get the low rate and maybe not actually waiting for the Fed rate cut.
Honestly, timing the market is tough. I would say
Yes,
if you're in a
yes. Yeah, that's
position,
great disclosure.
there is just like, I mean, the best experts out there, they've been saying rates are going to come down for over 12 months. Timing the market is a guessing game at best. I would say if you're in the position where you can afford a property, I would pull the trigger on it because yes, I do think rates will come down in the future, but also if you're working with a lender that has a relock program, this is something that our company offers. If you're in the middle of the
Not
process
HELOC, you
and
said relock, right? I just want to make sure you didn't say HELOC there. You said relock.
yeah, it's a relock program.
Okay,
So
explain that for me.
essentially, let's just say you go under contract right now. The interest rates are 6.25%. We get you locked in, and you're under contract for 45 days. You close on November 15th, right? Let's just say in November they do a rate cut and the rates come down 0.5%. With our company, they will lock you. It's called a relock program. If the market moves over 1/4% reduction in rate, they will relock you at that lower rate. And it has to be
Mm.
within 10 days of closing. But that's something other companies I've worked for over the last decade, none of them have that. And
And
it's
so
just
that's
a really
esoteric to
awesome
your
tool.
platform, by the way, right? Your company. That's not Wells Fargo.
Correct. Yeah,
Okay.
that's our company.
Because
I
there are
don't
some things
know.
that are company specific and some things that are loan type specific. So I want to be clear. I want to be specific.
Correct.
This is a you thing, not a loan program thing.
Yeah, this is a lender thing, bank thing. There's a lot of lenders and banks that don't offer that.
I
But
like that. So if I were to slip up and lock a little bit too early, I have a relock program that I could potentially go into. Okay.
exactly. Yep.
But let's go back to how can I get the lowest rate possible? How can I get the lowest, let me be more clear, payment possible? Lay out the blueprint for me if I'm just looking to achieve the lowest possible payment. Coming out of your market, Eastern Shore, Maryland, is of course housing market wise going to look different than Delaware, than San Diego, than St. Louis, than Boston, than Miami.
True.
In any and all markets, speaking broadly, what are the best steps that can be followed to achieve the lowest possible mortgage payment?
Honestly, it comes down to having the strongest possible credit score that you have. Outside of that, we can potentially look at rate, reduction options and buying down the interest rate. But it's also one of those things where you have to consider, how many months it's going to take you through the monthly savings of buying down that rate to actually recoup the buy down cost itself. And it may not make sense if the rates come down in a year and it's going to take you 3, 4 years to recoup that buy down cost. It may not make much sense to roll that dice where you might be able to refinance sooner and that cost would have been a waste to some extent. But I have clients right now that are in that position where they want the one client that is about to go under contract. She has to have the payment at $2,000 or under $2,000. That's like her cap, even though she's well qualified for over that level.
Okay.
That's where she wants to be.
And is that attainable in our market?
Yeah, she's buying a $385,000 home. She's putting $170,000 down plus closing cost. And that is putting her, I want to say it was like $1,988 with taxes and insurance. And we had to buy the rate down to 5.625% on conventional financing for that.
Damn. All right.
Yep.
So she got, if I'm following all that, she got the $1,900-ish payment that she wanted, but it was after paying $170,000 plus closing costs, and you bought the rate down.
Correct. It was 170 grand. And then the closing costs were about, I want to say it was like 20 grand in closing costs.
For a $385,000 house?
Yeah. Yeah. I mean, she could have put much less down, but she wanted to be at that payment or lower than that. And she was very adamant about it. But this buyer also had a plethora of assets. She had a settlement, and she had, I want to say like 400 or 500 grand in the bank. So that the assets and the money wasn't as much of a thing for her. She just wanted to keep her payment at that level.
What would the payment have been if she didn't put any down? If she put the minimum payment down on that house, $385K, what would the payment have been? Do you know?
I want to say it was in like the low threes in that, like,
got it. 3,300.
Yeah, I want to say it was right around that level.
Man. Because that's where my brain goes to with the person who's looking in on this housing market, looking up at it and thinking, how do I get in? Margaret over here has $175,000 to wave around. A lot of people don't have $175 to wave around. I digress. Right. Let's get in. I got 2 more questions on refi. Should I be giving any adjustable rate loans a look at all?
You're asking the wrong guy. I'm not a fan of adjustable rates. I personally would not look at them. I just don't think the risk associated with them is worth it. You look at so many people in the mortgage meltdown that had adjustable rates, stated income programs. The market got worse. The rates went up. They couldn't afford it. They probably couldn't afford it up front. But I think that risk, it's just not worth it for me. So that's my opinion.
And your opinion's based on a lot of fact. There's a lot of people who think they can afford more than they can, will take on too much of a risk for themselves. And if you leave it up to the bank to say you're going to owe more or less, I happen to agree with you. You're putting yourself in an unnecessarily risky situation.
Yeah.
Unnecessarily. Totally. And to your knowledge, if you can qualify for an adjustable rate mortgage, you more than likely can also qualify for the fixed rate, correct?
Yeah, more than likely. Yeah, because what happens with the adjustable rate, they have to qualify you off that fully amortized rate. And I think there's like a couple. I've never done one, so I couldn't actually.
I hear you.
I
hear you. And anybody looking at the refi route specifically should not be looking into refining into one, correct?
I wouldn't.
Okay, got it. I just want to be clear. Last one. What do you think rates are going to be this time next year? Let's play a game.
This time next year.
Complete guess. You have complete right to be fully wrong. I expect you to be. And I'll set the stage by giving you my guess.
We got to play this back, but go ahead.
We'll play this back. And we'll play this game again come December. We'll play the game. What do you think prices are going to be? We'll play that back. I think that rates are going to be low 5, high 4 for the best qualifying people. And I think the world kind of operates in America in the 5.5 to 6 range. What do you think?
You stole my guess.
Dang it!
I was going to say that as
a good guess.
Mid to high 4s on FHA, government, programs, and then I would say conventional.
That's a little lower than I thought. You said lower 4s on government, or mid 4s on government. Yeah, I guess if highly qualified government potentially. I guess I worry personally about we get too low in the 4s and we start to get into increased demandville because money's cheap again.
Right.
I get real scared about that because I feel like it'll only be pouring gasoline on a fire.
Yeah, and I feel like even if we see rates come down even another quarter to 0.5%, I mean, we already kind of saw it over the last
Armando,
30
buy.
days, but I think if these rates come down, you already know there's not enough inventory. The demand's going to go up,
How much
and it's just
inventory
going to
would we
create a
need?
what's that?
How much inventory? Where? Let me rephrase the question. Where do we get the inventory from? Armando, just great question. Buy or build? I say buy. Resale is going to be cheaper than building unless you're going into a community like a DR Horton, Ryan Holmes, K. Hovani, and Lennar. Someone that has a
Sure.
large scope and can get you a lower rate, maybe some closing costs in your pocket. But a lot of those guys beat you at the closing table when it comes to their mortgage companies. That's where a guy like Scott could come in and look over things like that for you. But where do we find the supply that's needed? Because we can talk interest rates all day. We can talk refining all day. And honestly, I think there's a lot of people who want to look at refining for the potential of being able to take their assets and even buy more property. But in order for that to become a shoppable opportunity, we need more inventory. We need more housing available. Where do we find it?
The government needs to put more incentives in place. You know, it needs to be one of those things where it's a multi-pronged approach. There needs to be, I mean, you and I have talked about it. What is the average cost a builder faces to actually build one property
Yeah,
with
regulatory costs.
local regulatory costs, county costs, breaking,
Close to
I mean, all these
$100,000.
things,
Yeah, close to
100
100,000.
grand, right? Which is why they're not building $200,000 to $300,000 homes, because once they buy the materials, they pay the workers, their profit
They get the
margin is
street pay. They put
so
in the light
small.
poles. Yeah.
Yeah, I mean, that incentive needs to be put in place. If they can eliminate that 100 grand, how many more homes at that level will we see? And maybe it's, you know, once we have an additional 4 million, that incentive goes away and the builders can no longer get that and it kind of goes back to normal. But you know, that needs to be done. And then they also need to control Wall Street coming in and buying up all these properties, because that
All right,
25% they're
boogeyman.
buying.
No, they're not. They're not buying 25%. Don't send out lies.
Last quarter,
Don't
it
send
was
out lies.
25% of all home sales.
Where? Where? We're bringing up the screen share. We're bringing up the screen share. I need fact checking here.
Pull it up.
I thought, okay, so just I want to lay out what I think. I think 25% do buy homes that aren't their primary residence. But you're
Correct.
talking about Wall Street, right?
I'm talking about just investors in general. Wall
Oh,
Street,
you
mom
said
and
the word
pa.
you said the word
I
Wall
know,
Street.
I
You said
know.
the word you
I know,
said the big
I know.
boogeyman word. You
I
said the
boxed
big
myself in with that,
It's all
but
good. It's all good. So, but
I'm in everybody.
to be to be clear, Wall Street, BlackRock, Blackstone, all of them have a humongous ownership in our corporations here in America and definitely have real estate holdings. But we're only talking about 2 to 3% of purchases or ownership is by them. There is a gigantic mom and pop investor market, though, that absolutely, like you just said, 25%, 1 out of 4 buyers are buying homes as commodities and not as a necessity. They're purchasing it as an asset for their portfolio, not as this is shelter for my family.
Right. Yep.
Does that bond ever get broken, do you think? Does American housing, are we too deep now to even look at other options on how housing could be viewed more as a commodity, or I'm sorry, not as a commodity, but as a necessity, a requirement, something that is truly a part of the American dream without being given away? Of course, there's people who've worked very hard for their home, and I feel it shouldn't still be handed out. But for most, it's not even about hand out or work hard for. It's if I went and got 2 jobs, we both did necessarily, assuming you're married, you probably still are in a case where you're not being able to afford a home, because we just talked about Margaret, who bought a home 4 years ago. She can sell hers, has 180K in equity, then she can move into the next one.
Yep. So true.
Where does the shift happen, or is one in play in any way? I guess I'm asking. I know I'm asking you a question that really doesn't have an answer, but where does somebody look when we're talking about refis and you're talking about getting your original financing, right? You're looking up at this big market, trying to get into it. Where is the easiest access point?
I mean, you can get some pretty darn good deals with these builders right now and the buy downs that they have. But you know, it's just one of those things where a lot of those properties are in the higher price points. They're at the 4 to 600 plus sales price range, which a lot of people can't afford, even with 2 jobs with both borrowers. And it's just still unattainable. So I don't I don't know the answer to that question. I think there's a lot of things that need to be done from the government standpoint, and without that, I just don't think it's the needle's really going to move.
I'll ask you another hard question, and I'll answer it myself. What's if you were in charge for the day and you did get the ability to change one thing about our economic policy, our housing market? How would you dive into that problem? If because I agree with you, I think the government gets you into the problem. Government's got to, in a way, get you out of it. I think we have pigeonholed ourselves into a lock-in effect because we made rates too low. The Fed rate dropping in April 2020 to 0 for the first time ever was a huge mistake. That can be looked at right by the red policy, the Trump people. That was a mistake by the Fed under that policy. Then the Fed continued on with these low rates all up until late 2021. And then, dude, the rate went from you could get a 3 to you could get a 7 in 10 months. And that was huge. That's a gigantic swing. So we go from money is cheap and everybody's out buying homes on limited supply because there's not enough homes because of COVID. People didn't want their homes seen. And now we see home prices have escalated.
Yep.
Is there anything you could do if you were in charge for the day in the government to undo what's been done?
I don't think there's just one thing that would move the needle enough where it would make sense. I think that there's so many things that need to be done. I think RFK has had a lot of great ideas, and I'm glad to see that he has partnered up with Trump and is working with the Trump administration. But his 3% down or 3% rate program for first-time home buyers, why is there not like an incentive in place for them to be able to get a lower rate if they're buying a primary residence? That's their shelter that they're going to live in, that their family's going to survive in. There's things like that that need to be put in place, but I don't think there's just one thing that would solve the problem, to be honest.
And the 3% mortgage program, that if I'm bringing that back to recollection, RFK, Bobby Kennedy, who isn't running with Trump but endorsed him, correct? He's not on the cabinet, right?
I thought that he was accepted some sort of a position with the Trump administration.
Okay,
I thought I saw
maybe
a headline that
back,
he was working
back
with
to
them
your
or
point on the
something like
3%. I hope he just gets in there and fixes food. I think that for him
That
and his
too.
weird ass
Oh,
voice, I hope he gets in and fixes the big food issue because he's very passionate about that. And he's the only person talking about it. The housing side, though, you're right. He had this idea on we pay into bonds, like there are bonds you could buy that would pay into a fund for first-time buyers to access a 3% rate. Am I correct on that?
That's correct. Yep.
Okay. I do think things like that could be explored. We've used bond sales to fund entire wars, so I don't see why we couldn't do that. I think I would incorporate something that added a deeper, I'm going to sound very Kamala Harris, a deeper tax on the rich. I think home investors, real estate investors specifically, make out better than many people know. You don't get charged as an investor for buying an investment property at a closing table. There's no extra tax. If you sell it and make money, there's things called capital gains, of course, but there's no immediate detriment to your finances for buying an investment property, especially if you're doing it mostly, if not all cash. Then the rental income that you secure, there's so many tax benefits. There's so many write-offs. It's hardly even taxable. And then when you sell the property and make your money, you can do this thing called a 1031 exchange and not pay taxes on it and just move it to the next and move it to the next. You can do it infinitely. I would incorporate something that's going to make that a bit less of, as we said earlier, a commodity, an asset. This is a necessity. This is a need. This is shelter. This is we just saw after what happened in Georgia and South Carolina, North Carolina, all the way up to Tennessee, how valuable purely shelter is and how that can be ripped away. And we treat this like it's a part of our investment portfolio. And I know mom and pop building their 5 and 6 rental properties aren't meaning to topple the housing market, but you mentioned it earlier. A quarter of the purchases in America, more so than, are made by an LLC or someone who doesn't intend to live there. So I think taxing those people to alleviate a little bit of the damage, maybe push some of them off from even wanting to do it. But at the very least, if they do, let's tax you, let's penalize you now and build a fund for someone who actually wants to buy the home. Let's put a 30-day ban on you being able to put an offer on the home until it's been on the market for 30 days. Let all the families go after it. Bring in a 3% mortgage program for only first-time residential buyers that investors and secondary owners can't touch. I love those ideas. I do. I think it does come down to supply, though. I like that Kamala wants to try to build 3 million homes. I'd like to know how she's going to do it. Trump said how he's going to do it. I don't like how he's going to do it. He said we're going to do it on federal lands. I think there's going to be a lot of issues with that. I don't have the exact solution. I think, though, if you're solving a demand problem or a misweighted problem, you could go right after the investors if we're trying to shift the weight in favor of other buyers. In terms of bringing more sellers to the market, more homes to the market, you got to fix zoning laws. Minneapolis got really, really aggressive in their Minneapolis 2040 plan with that. And you can look that up. Just Google Minneapolis 2040. They eliminated all single-family zoning and only allowed multifamily in their downtown area. Crazy. Outside of some vast zoning change, though, a lot of these areas can't even find more room to build. So it's a weird scenario and not one that I want to be in charge of fixing. But I do agree that there are ways that if we look at it from an unconventional standpoint, and I'll finish on this with the unconventional standpoint, that we could fix it. You remember, did you bring it up to me or did you send it to me? It was a couple months ago where an AI bot was tasked with fixing the housing market.
Yeah.
You remember
I
that?
remember that.
And the AI went through and it had all the plugins. It knew the price points of homes. I think it started in like 2002 and it built it out, fed it everything that had happened, gave it all the correct metrics and said, hey, you're in charge. It's the summer of 2024. Rates are high. First-time home buyers are struggling. Investors own a lot. What would you do? And they basically said, hey, there's no rules to this. Just fix it. Like, don't use conventional wisdom. And it said, okay, I fixed the problem. It took a year and a half. And after 18 months, getting rid of landlords fixed the problem. Scott, should we get rid of landlords?
I don't know, man. That's
it's a cool, it's definitely an unconventional solution. I don't even know how you even start.
How would you do it? Outside of like putting like insanely, it's just, I don't know how you would even accomplish that.
I don't know. I don't think you can accomplish that, but I love that the AI did step in and say, maybe if we talk about these investors real fast, it seems like they're causing a bit of the issue. Scott, end on something good for me, dude. What's one positive going on in life? Give me something good.
These the rates have come down, but I think buyers still have a little bit of leverage right now. I'm having offers accepted at list price. I had one the other day that got some seller concessions. So I think the silver lining with where the market is right now. Am I frozen? Can you hear me?
No, you're coming in beautifully. Yeah.
Sweet. No, I think the silver lining and where the market is right now is there's still opportunity out there. I think that if the rates continue to go lower, that opportunity will likely dry up a little further and it'll be a little tougher for home buyers. So I think if you can purchase now, great. I think you have a little bit more leverage than you will if the rates come down in the next 12 to 18 months like they're expecting.
Makes complete sense. So if you were sitting on the fence for a refi, you would say rates probably won't drop dramatically in the future, but could be an opportunity.
Yeah, absolutely. And if you can drop it at least 1%, you're staying there long term, I would do it. And then if it presents an opportunity again for you to drop it again 1% or 0.75%, and you're staying there in the long run, I would do it again.
So you're saying if you refied today and then the rates did drop another %, you're not out of the woods. You could still refi again?
Yeah, absolutely.
Okay.
Now there are limitations to that. Most of the time you have to make at least 3 to 6 payments on the loan to do that. Like VA, you've got to make 6 payments. I think it's like 210 days from the last funding
but like
date.
You said, a year from now, next fall, even you're walking into winter and rates get lower even again. And let's say you refi today, a year from now you could refi again in most programs, correct?
Exactly. If the opportunity presents itself.
And it made financial sense, which is why someone in your corner, having someone like you, is huge to walk through those numbers without connection to the commission. Can I bring up one thing about you that I love that you won't say about yourself?
What's that?
Don't feel uncomfortable when I say this, all right?
Oh, man.
You do a lot of mortgages, Scott.
True.
You do a lot of mortgages. Can I say one thing about the mortgage industry and mortgage lenders specifically right now?
Yeah.
A lot of mortgage lenders aren't doing a lot of mortgages.
True.
There's frankly a lot that are struggling in the real estate industry as well, on the realtor side. But on the mortgage side, we've had fewer mortgages than ever in a year where now back to back, 2024 looks like it's going to be less sales than we had last year, Last year, we had a record low in sales since 1995, 4.09 million across the country. We think we're going to dip below 4 million this year. Less mortgages within that ratio as well. So we know less people are doing business. And frankly, dude, that makes you so much more valuable in my books. You don't need the money when there's a lot of people out there right now that are banking on your one mortgage closing, your second mortgage. Like, and I can't stress how much that sounds bad. I get it, but it means something. You can have somebody banking on their utilities getting paid on you getting a mortgage. And if you didn't think that's going to factor into how they advise you, I wouldn't take that risk. That's all I'd say. I wouldn't take the risk. You have the ability to work with somebody who has a team, who's doing business consistently, can do all 49 states except New York, screw New York, and can offer insight that's going to be unbiased because, frankly, you don't need to close the loan. You can look right at it and say, not smart, don't do it, bye, and be honest with people. And I think that's a qualifying asset to you that not enough people talk about, especially yourself.
Thanks, man. So we have a real fiduciary duty, but the problem is there's, like you said, there's so many people that are motivated by that commission, and so many people are struggling so much right now. I actually have 3 deals right now that are closing in the next 30 days, home buyers who were pre-approved by someone else and they didn't do their due diligence, and they're just throwing as many deals at the wall as they can to try to make as much as they can. And they came to me after the fact. The past client referred them to me because they were running into issues and they weren't going to close because they were getting denied. And in 2 out of the 3 situations, we were able to finagle a creative solution. And the one I was able to get an exception from our executive team on. But there's, to your point, there's just so many people struggling right now, and they're just not doing the job the way it should be done, for sure.
On the realtor side as well. It almost sounded like you're talking about realtors there in a second. All right, I'm going to finish it there, friend. I think that's a good synopsis. We went through our Fast 5, the 5 documents that we think you need to be reviewing, the 5 articles we saw about real estate in the last 48 hours that we think you need to see. Gone through about 10 of those 12 questions about refinancing. And as well, if you're patching in on the TikTok or YouTube live side of things, you were able to patch in a comment or text the line. Feel free to come back in as we're going to now be moving to 2 slots next week. Have we decided on our days? Are we doing Monday and Friday, Monday and Wednesday?
I don't know if we've decided, but I can do either.
Listen,
we'll talk about it.
We've talked about it. The virtual side of this is so cool. We know so many cool people, so many smart real estate minds, so many awesome personalities, and we're going to bring them on into the show, bring them into this space. We're going to be able to share social media platforms so that we can culminate audiences and bring in new insights and new perspectives. And frankly, I'm honored to be with you at the beginning of this because we've gone through a bunch of different shifts and how we're going to do it. And you were traveling like a 3-hour span just to shoot one show each week. People don't know that. So now the ability for us to do 2, 3, maybe even more of these and be able to connect in with the people that we know within the industry across the country is going to be really fun, dude.
For sure, man. I'm so excited, and I appreciate you too.
Hey, listen, I'm just a tech geek. You're the man. All right, y'all, have a great one. Subscribe to this man. Subscribe to the show. Otherwise, we'll see you next week, 2:30 to 4:30, Monday, Wednesday. We'll say Monday and Wednesday.
Sounds good, man.
All right, y'all. See you guys.
All right, guys. Peace out.
All right, I'm ending on mine. Let me go on y'all's. If y'all are seeing this right now, you're not supposed to.
Dude, this looks so clean. Look at that.
1 second, dude. 1 second.
It's so damn clean. It looks so good. Oh, you can't really see it, but dude, it looks so good. Oh, we're still live on my TikTok.
Yes, we are.
Okay. What's up, guys?